and on behalf of Liontown, it's a great pleasure to welcome you and to thank you for joining us at short notice for this special investor teleconference and webcast. Today's presentation follows the release of two very significant announcements by Liontown yesterday, namely the announcement of a binding offtake agreement with the leading global automaker Ford, together with a debt facility for the Kathleen Valley project, and the announcement of a final investment decision endorsing the full development of the project and paving the way for the commencement of construction. The format for today's call is as follows. Liontown's Managing Director, Tony OTTAVIANO, and Chief Operating Officer, Adam Schmitz, will run through a short, synchronised slide presentation to update investors on offtake, funding and project development activities at Kathleen Valley. We will then open the floor to questions. Firstly, we will take questions from the teleconference. For those of you who have joined by phone, please press the star key followed by the number 1 on your telephone keypad to join the telephone question queue. Once we have worked our way through the teleconference questions, we will go to questions from those who are participating via the webcast. To ask a question via the webcast, please click the Q&A tab on the bottom right corner of your screen. Please type your question in the pop-up box that appears. I will endeavour to put as many questions to Tony and Adam as we can in the allotted time. Please note that a recording of this webcast will be available later today. Thanks very much everyone for joining us. I'd now like to hand over to Liontown's Managing Director and CEO, Tony OTTAVIANO. Tony, welcome, thank you, and please go ahead.
Thank you, Nicholas, and it's a great opportunity for me and Adam to present today to our shareholders and investors and future investors. I think it's best to sum up the last 24 hours have been a profound milestone for Liontown, one of many that we've pushed through in the last 12 months. As Nicholas mentioned in his opening, this paves the way for us to start construction and build the world-class Kathleen Valley project. But not only just build the project, we're here also to build Liontown as a significant producer on a world scale of lithium into the future EV demand. I do have some slides that I'd like to go through just to touch on our specific attributes of what we've done, and it starts with the investment highlights. We will talk about in this presentation our ESG credentials and how it's core to our strategy. And I'll elaborate further as to the commitments we've made in our pathway and aspiration to be net zero by 2034. We've got an ore body in Kathleen Valley that is world-class in size, in quality, and position on the cost curve. It enables us to be able to expand on a low-cost basis, but have a long life, which will underpin our future aspiration of being a refiner in our value maximising pathway. We are funded now to first production. We've done the equity raise back in December 2021, where we raised $463 million, and now coupled with the $300 million debt facility from Ford, we are well funded to take us to first production. I've spoken about the Tier 1 qualifications of the Kathleen Valley deposit. It has a resource of 156 million tonnes at a grade of 1.4%, but a reserve of close to 70 million tonnes at about 1.39% grade lithium. Again, both those attributes generate some compelling and outstanding economics for the Kathleen Valley DFS. On the offtakes, I think I'm very proud to say that we've assembled a list of customers that are Tier 1. Starting with LG, the biggest battery producer in the world, followed by Tesla and Ford, both pillars in the automotive industry. Something like Ford, that's an American icon, and Tesla has paved the way in the EV thematic. We believe we'll bring production on perfectly timed to meet an emerging supply deficit. And we'll talk about that further in the presentation. And we're building an experienced leadership team. We've got some very highly qualified members of my team that will take us, that gives our shareholders confidence that we will be able to build this, and not only build Kathleen Valley, but build this company. But we've also got a very experienced board that will provide the guidance and stewardship that we need to move through this fairly, let's say, challenging environment. It starts with our strategy. Our strategy has three horizons. Our first pillar is to look and develop Kathleen Valley to its full potential, and we can see that in the first box. The second component of our strategy is downstream production. As I've mentioned in my opening, it is the value maximising pathway. So we will move, we've already done a scoping study in our refinery, and we've moved it into PFS now. And ultimately, we want to make Liontown to its full potential. And to do that, we want to continue our exploration success. We've got Boldania there as future mineral inventory, and we believe we've got genuine IP in the area of lithium exploration. Quite in my opening in the highlights, I've spoken about ESG and how it's core to our strategy. And typically most people tend to focus on the E first, but I do want to talk about the S, the social element. It starts with our traditional owners, our partners in this project, the Joal. We're very proud to have secured the native title agreement in November 2021, the first and only native title agreement signed since Julian Gorge. We've also received the Section 18 clearance permit from the government in May of this year, and we've now got our small projects permit that's allowed us to start early constructions of our camp, which Adam will speak about later in the presentation. These are all fundamental requirements for our licence to operate. On the environmental side, we are out to tender at the moment, and we're now adjudicating those tenders on our renewable farm. We're aiming for at least 60% renewable from day one. We will build a solar, wind, battery backup with gas redundancy farm. We're also having a big focus on making sure that we're very efficient and effective with our water usage, putting in a lot of capital in making sure that we can recover and recycle processed water as best we can, given how valuable a resource it is in this part of Australia. And then finally, our customers and governance. The customers have been very strong on ESG, very strong. And we've had to make we had to meet certain hurdles for the customers to feel the confidence that they're backing a producer in a tier 1 jurisdiction that they can rely from an ESG perspective. And on the governance side, we've already issued our very first sustainability report, which clearly articulates the standards in which we're going to align with, but also the particular standards that we're going to set ourselves to match, and the specific targets that we want to hit and KPIs. There's been a lot of discussion in recent times around supply and demand. I think that the very recent Pilbara auction, which showed a further strengthening of the spodumene price, is completely aligned with how Liontown sees the market. We believe that supply will be harder to bring on than people think, and therefore the deficit will continue to prevail. And for me, the fact that supply, in order to meet the demand, has to come from jurisdictions which are not as favourable as Australia, just further reinforces the risk associated with proper and compliant new supply coming from jurisdictions that the automobile industry can rely on, and Australia is on top of that list. And even if you believe that demand isn't as strong as people are forecasting, right, and reduce the demand as we show on this graph, the deficit continues to prevail. On the right-hand side, we show the various chemistries that the market is currently producing, and in each one of them, lithium is a foundation chemical. So for us, the risk of substitution is very, very low. I mentioned in my opening remarks around the quality of customer suite that we've assembled. And for me, it stands on its own in terms of these customers recognising and validating Liontown and the Kathleen Valley project. We wouldn't have assembled this quality list of customers if the resource wasn't tier one and the management team was not here to support its construction and development. We've secured 90% of our production under contract, and we will leave at least 10% for the spot market so that we can further stimulate that pricing mechanism and that price transparency. So our capital cost to first production. Our DFS had a figure in the mid-range of 473 million Australian to deliver the capacity that we require with that scope. The DFS has a plus or minus 15% accuracy range, and with further work through our front-end engineering and design, the feed, and some value engineering, which is part of that feed process, we've taken a much more detailed view of our capital cost requirements to build. We've done some scope optimization to further improve the operability and the efficiency of the plant. And I might just turn to Adam now to just give you a sense as to what's included in that 53 million.
Yeah, so thanks, Tony, and welcome everybody. I think the key with, the feed was really to validate the DFS and identify, as Tony said, opportunities. So we've started from the mine all the way through. Mine optimization is ongoing, but in terms of what's driven a lot of that step change you see on the bar chart, we've optimised the feed bin, we've optimised the tantalum circuit, we've revised the crushing circuit, we've upgraded the camp, I think, in tune with, where we think the camps are going or the villages are going in WA, with a recent press around the sexual harassment cases. We've included CCTV cameras, we've included hotel-style door locks, and we've actually taken a much more proactive approach, I think, around the camp. We've also laid the camp out with some cultural input too, so there's a fair bit of work gone in there, not just building a camp, but building a camp that fits. We've also allowed significant money for sparing. We've already ordered a spare ring gear for the SAG mill that we've yet to get, so just to give people a view, that's a $1.5 million purchase and it's sort of an 18-month wait. We've allowed for incentivisation, we've allowed for labour costs of our own team. We've included an on-stream analyzer, which is state-of-the-art for lithium. It's something that's been trialled for a number of years down at Greenbushes, and now they've ordered a couple. We've ordered one and included it in the circuit up front. We think that'll significantly improve our ramp-up and our operability. We already have rigs on site today doing grade control. So for the first 2 years of mining, we are grade controlling today the open pits so that we can optimise the mine design, and that's not a cheap exercise. As people appreciate, we're drilling that grade control from surface. So there's a $3-4 million hit alone in there. Plus we've upgraded our accommodation, as I mentioned, and we've also moved on to even the sampling regime in the port. So we're trying to future-proof, the whole value chain of what we're building.
Thanks, Adam. I think I'll make two further points. Given the world supply chain issues and how much delivery times have blown out, we've gone ahead and ordered strategic spares, the ring gear being one. we felt that we needed to insure ourselves against catastrophic failures that occur, and if that was, God forbid, to happen, we'd be protected because we've invested in these strategic spares, given how much the delivery times have blown out. The second bit is the inflation. We've acknowledged that there will be inflation, and we've factored that in. We could have gone in and put 30%, but we're backing ourselves. We've debated this as a management team, we've debated this at the board level, and we believe that through the project execution strategy that we're going to adopt and our general philosophy around working very closely with our contractors and stakeholders, that we will manage our costs. And Adam will talk about that a little bit further. So then I look at the source of funding. The debt facility that we've been able to secure with Ford is a compelling offering commercially. We saw the rates and the term, and I think the other point that we wanted to make is the debt facility and the offtake arrangement were both negotiated at arm's length. One didn't compromise the other. And then we've allowed ourselves further buffer for any potential unforeseen cost impacts. And I think that's only prudent, that is there as buffer and not factored into the base case. Because again, we want to back ourselves that we've got the right systems and processes to get this right. I won't go into this too much. The details of the loan, as I said, are very commercially compelling. And for us to compare this to the standard banks and tier one financiers, the board felt that this was in the best interests of the shareholders, given how attractive the overall commercial requirements of this facility agreement were. The other point that I want to articulate to shareholders and investors is we want to make it as part of our DNA that if we make a commitment, we stick to it. And I think you can see from this graph or this illustration that every time we've put a commitment out, we've hit it to the timeline. And the final investment decision was just another example of that discipline and how the board and the management team want to deliver this project. But not only to deliver this project, but build this company. We're not publishing DFSs and then, 18 months later, they're still sitting there and the project no further to commencement. We published the DFS in November. With 1 week after that announcement, we started FEED in order to meet our FID decision yesterday. Just on the project update, I've mentioned we've done the final investment decision. Adam and his team are progressing the detailed engineering. We've done a lot of work in issuing key contracts for tender, and Adam will speak to that already in a few minutes. But on the procurement, and you'll see from some of the pictures that we're going to show you, we're well underway with all the long lead items. We ordered them in advance as a risk mitigation strategy to avoid any delivery time risk and therefore any risk to the overall schedule. The project team's expanding. We're building the team. We're now funded to first production, and we've got all our offtakes in place. We're still working on our tantalum. Everyone focuses on the lithium, but the tantalum offstream is also very attractive and lucrative, and we've got a number of key customers willing to engage with us to procure the tantalum stream. The final point that I'll make before handing over to Adam is, it's not just about building Kathleen Valley. We've got to build a company. And it starts with, we've got commitments in the form of our license to operate. And we need to put our ESG credentials first and foremost. We need to build the team the team that will build the project, but the team that will generate the support for the project. We need to install systems and procedures and standards and policies. And you cannot manage a company where we aspire to with no systems and no processes. The enemy is not process. The enemy is bad process or too much process. So we're going to be very aware of making sure that all our processes are fit for purpose and all our standards and specifications are written by the people doing the work that know best. And then as we move from developer into operations, we need to have operating excellence first and foremost. And this will become more and more part of our lexicon because we're getting closer and closer to operations. And we need to move into that mindset. And at the core of that is the people on the front line. So, project execution strategy. I'll now hand over to Adam to give you a sense as to how deeply we've thought about this.
So I think everyone's aware of how tough the market is, and we're very close to that, and obviously hear about it every day, but it is very tough. We've put a lot of effort into how we divide up the scope for the project and battery limits. We've put a lot of effort into lining up the right EPCM partner and actually putting a contract in place, which is imminent in terms of sign-off, with the right contractor, one that's going to be with us through the journey. We've been very clear in that EPCM contract that we want to lock in some certain costs. So the engineering and procurement portion of that contract is a fixed price contract. The construction management is a reimbursable. We think that's the best mix between fixing a portion of the project and not. In differing markets, you might go with an EPC or a lump sum for the entire project. In the current market, you'd pay an enormous premium for that. So we're attaching a lot of value to our team and the ability to manage that construction management part of the project. And that design phase is well advanced as part of the FEED. The FEED was very beneficial to the project in terms of identifying opportunities and actually risk mitigation. Through the engineering and execution phase, a key part of our native title agreement is engagement and involvement of the Joal, and that's from a contracting and employment opportunities perspective. So we've actually built that into our contracting process and already awarded a key contract to a Joal business. Long lead, as Tony's mentioned, as you would have seen in yesterday's announcement, about 73% of the mechanical packages have been awarded. To put that in perspective, we have ordered all of the key processing equipment with the exception of pumps and thickeners in the entire processing flow chain. That's obviously on a lead time basis, but it also allows the engineers free rein to design the plant, because without the vendor data from the equipment suppliers, you're not designing the steel or the concrete. So that's also a key part of that long lead and locking in that equipment. Critical contractors, we've awarded the village, as you would have seen from yesterday's announcement. Those guys are on site. We're clearing. The first concrete slabs for the first 6 rooms are in their yard next Monday, and room manufacture is underway, and we want to have 80 people sleeping in those rooms in October this year. The power station contract is a massive contract that's been in the market. We're adjudicating it now. As Tony mentioned, 60+% renewable power. It is a monstrous power station, 5 wind turbines, batteries, gas, a lot of effort going in there because it's a big cost, obviously, for the future operation, and we're signing up for, well, we're basically marrying a power station provider, in all honesty. So a lot of effort going in there. Likewise with bulk earthworks, mining has been in the market. Gas is similarly being treated as a very, very big priority. We're also negotiating with the port because you've got to actually sell the product and get it out of the country. And concentrate transport, a key part of the supply chain, will go out in the market today. So a lot of engagement with early contractors. A big thing that we focus heavily on is the design to build approach. So a lot of our design, structural steel especially, we've actually designed to be built on the ground and lifted up in big panels. This is to take people off site and actually expedite the construction. But we're also designing a lot of the steelwork in much bigger pieces and a lot of the concrete works as well, so that we can build it off-site and bring it in large chunks, again, to try and mitigate any schedule risk, because we see that as our number one risk in the current market. We've obviously recruited pretty heavily. The company, when I joined 2 and a bit years ago, was a company of 5. We've significantly, orders of magnitude have been recruited in the last sort of 6 months to I guess, future-proof the company and also allow us to actually do what we need to do in the current market, which is direct not only the engineers, but also get ready for that operation. So a lot of effort is going in now in terms of operational readiness, software purchasing. We've bought S4HANA. We've bought a very, very good safety software. So we're really trying to lift the standard of the company.
Thanks, Adam. Maybe some quick...
Look, I've touched on the design already. I think, as Tony said, this is the first company that I've ever been involved in 25 years of working in the mining industry, where we've transitioned from a DFS to feed to within a space of a week. Normally it sits on the shelf for 6 months while people procrastinate and work out whether they do want to go forward. And that enabled us to get that SAG mill purchased in the first week of January and locking in that sort of 52-week lead time on that key part of equipment. And that equipment, as Tony said, included a spare gear, it included a spare pinion, it included a spare motor. So it wasn't just, let's just buy the SAG mill. All major equipment, as I said, is ordered. All areas of the plant, as of today, will have passed the 20% design review. So we're significantly advanced with this. We're not actually just talking about it.
The camp, the Dragonfly.
Yeah, so one of the major stories, if you like, one of the Dreamtime stories for the Joal in the region involves some dragonflies and chasing a snake up Jones Creek, which is adjacent to the project. We've actually laid our camp out in the shape of a dragonfly, and we've actually progressed the camp very, very early because, in terms of project enablers, accommodation is up there. The first rooms the first 80 rooms will be filled in October. We've got a very nice contract awarded. We've stuck with our strategy in terms of dividing the work scopes up to smaller contractors. So the camp supplier is not your mainstream camp builder that a lot of the big guys are using for a multitude of reasons. One, because the big guys are all busy, and two, they're charging like wounded bulls. So we've tried to avoid those sort of downfalls. We've awarded to a group called AD. The buildings have had a lot of input in terms of the design. They're designed to be built. So these are concrete floored buildings. They're a high quality building because we want to attract high quality people to the site. And camp and food are obviously key enablers for that, along with what you pay them. So those off-site rooms, we start next week actually putting the walls up. We've got a small operations proposal was approved from Demirs as well. That allows us to start and clear 10 hectares on site prior to getting the main permits approved. So it's a big project enabler, and there's a team already on site and a 16-man construction camp already on site with work happening right now.
Thanks, Adam. Look, just to conclude, our investment opportunity for those on the call that are yet to invest, the asset speaks for itself. We wouldn't have attracted the quality of customer, but also the quality of stakeholders and contractors if the Kathleen Valley deposit wasn't tier 1 in nature. And I think the jurisdiction in which we operate, Australia, is also a huge attraction to current and future customers. We believe we've timed it to perfection as the deficit starts to increase. Our ESG credentials, I've spoken about that. I think that's a very important factor moving forward. And I think this is a point that I want to elaborate on a little bit further. Given the size of Kathleen Valley, we can become a fully integrated raw material producer of high quality lithium product. I mean, a deposit that has a 25-year mine life or more can underpin further investment in the form of refinery. So the near-term priorities, I think Adam's elaborated on that. So that brings us to the conclusion of our presentation. So, Nick, over to you.
Thank you very much to Tony and Adam for a great presentation. We will now commence the Q&A portion of this webcast, and as I said at the outset, we will start with those who have joined via the teleconference. So to facilitate that, I'd like to hand over the floor to our teleconference operator from Chorus Call, Melanie. Melanie, please go ahead.
Thank you. If you wish a question on the phone, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Stuart Howe with Bell Potter Securities. Please go ahead.
Thanks, Tony and Adam. Really good presentation. First question's around Offtake, and obviously the linkage to lithium hydroxide across the basket of contracts. And I guess, do we see scope that we might be able to get some guidance on that linkage, I guess, across the basket? I know that individually they're commercial in confidence, but is there a way we can sort of see some of that additional value you're capturing? And then also secondly, with respect to Offtake counterparty, what sort of engagement do you have with those customers between now and first production in 2024?
Okay, Stu, good to have you on board. Let me start with the second question. There are requirements under our offtake agreements that we have numerous touch points between now and what we call commercial production, or the declaration of commercial production. So there's a number of commitments that we need to provide the customers to give them confidence that we're on track to deliver. So that will be ongoing dialogue between the various parties. Now, in terms of the pricing and the pricing mechanism and the relativity between the three, again, you're absolutely right. They are commercial in confidence, so I can't divulge too much. There is consistency between the various agreements in terms of the way the pricing formula works. But I think more importantly, if you wanted a steer, we provided you with a DFS view that we got from Woodmac Roskill as to what we believe Roskill's future view on spodumene. I don't think we're going to be in trouble of being below that with our current views and current pricing formula.
Okay, thanks, Tony. And just secondly on the customers and ESG in particular, what's most important across those three components? What's been most important to the customers? Is it the carbon footprint, environmental management, or is it the people and culture side? What are they most targeting?
I'll give you what I've experienced talking to the negotiation team for each of those customers, but I'll also hand over to Adam, who had direct engagement with a number of the customers' ESG teams. But for me, clearly the carbon footprint is important, but there's also other aspects of the ESG that they're very interested in, and that is the S. So we've got commitments under the Equator Principles. We've got commitments under anti-bribery and corruption. We've got commitments under anti-slavery. Those sorts of things. Now, clearly, a Tier 1 jurisdiction like Australia, we can comfortably meet those requirements. But nonetheless, there are also requirements around how we operate and whether we operate in a manner that doesn't damage the environment. Adam, do you want to add anything further?
Yeah, I think from my interactions, most of the customers were pretty impressed in that we'd started our ESG journey very early. I guess they were thinking, the approach we've taken is we see it as part of the project development, not a tack on, if you like, at the back. We also see it as integral to the project, so we've tried very hard not to greenwash, and I think that's come through to the customers. And we've also tried to align ourselves from a governance perspective. That was particularly important with one of the customers, with the world-class standards, if you like, in terms of IRMA, in terms of GRI, in terms of SASB. So we've covered ourselves, I guess, if you like, the three sort of governance and sort of due diligence standards. We obviously put a lot of effort into the native title, and I don't think we got, well, maybe I'm being a bit defensive, but we never got the credit, I think, for the amount of effort. That was a 2.5-year journey, and it wasn't an easy one from both sides of the fence, and it continues. So it's a key part of our project development strategy, and we actually talked to that with one of the customers as well. So I don't think any one factor. Obviously, we zoom in a little bit on our 60+% renewable power, but the 60+% renewable power more is an enabler as much as anything. Tony, I don't know.
Yeah, that's good.
Great, thanks guys, I'll leave it there.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Reg Spencer with Canaccord. Please go ahead.
Thanks, afternoon, Tony, Adam, thanks very much for the presentation. You provided some good detail around the CapEx increases and the influence of cost escalation in that. Can I ask about cash costs in the DFS? You guys estimated on average of about $330 a tonne for concentrate. At this point in time, have you got any visibility or idea what that might have increased to given current industry pressures?
Yeah, good question, Reg. I think the only, vibe we've got there at the moment is perhaps a little around the labour. It's gone up a little bit, no question, anywhere between 10 and 30%, depending on who you talk to. We've already, future-proofed a little bit of that in the DFS because we picked the 75th percentile in terms of the salaries that we'd selected for the team. The other one that we've seen as a step change is energy. The gas cost has gone up, and we're factoring that in as we speak, mainly around within WA. But we're also, it's a bit of a circular story for us in that we're playing with the renewable percentage that we have as well to try and mitigate some of that. So it's a bit of a circular story. They're probably the biggest step changes I think we've seen. Capital-wise, I think it's separable to the operating, but they're definitely the two biggest input changes that we've seen.
Yeah, and just to add to that, Reg, talking to some of the mining services folk, because clearly we're out in the market at the moment for the open cut, and we will be shortly for the underground mining. There's a view within the industry that maybe peak labour rates we've got there, and that probably February was the last push for a significant increase, and things are now seeming to plateau. So we're confident by the time we need to award and having the appropriate rise and fall mechanisms in our contracts, that by the time we get into production, we are comfortable that we've got the cost element managed.
Yeah, in terms of the open pit bids that we've received, I think when we did the DFS, we picked the mid-range, in terms of a plus minus, about 10%, I think is how it worked out for, say, the open pit. We're now in the bottom quartile, I would say, based on the bids that we've received. But there's still work to go there again around scope optimisation, which is what we're working on now, especially with the grade control work we're doing.
Excellent. Thanks, Adam. Thanks, Tony. Just one more question from me. You've got the funding now. You've got a good buffer on that funding package. You've got your FID. You've got all your permits in place. You've got all your offtakes. Can I ask what aspect of the development of this project are you now most concerned about?
Permits, yeah.
Yeah, so we've still got a couple of permits to conclude, but we don't believe that's going to be a concern. I think Adam's already touched on what we believe is the biggest area of focus, if you call it risk, but we want to manage, and that is schedule. Okay, so we've ordered the long lead items, so we're comfortable that the ordering and the supply chain delivery issue won't manifest itself, but they haven't arrived on site yet, so we've still got a little bit more. But building this thing and making sure that we get the parts of the equipment in time in order to conclude the other parts of the construction.
I think that's right, Tony. I think schedule risk and mitigating that risk and managing the construction risk, I think, would be the elements that everyone is seeing in the market right now. And that's an area we've been focusing on for a long time, and an area where we've deliberately adopted a divide and conquer approach in terms of smaller contractors and breaking up the contracts into smaller chunks. In terms of the equipment orders, a lot of our orders have gone to one vendor in particular, a very, very good vendor, and I think that'll help in terms of the ramp up and delivery, and also leverage for mitigating any delivery delays as well.
Yeah, I think the last point I Rich, is that we're putting an incentivisation scheme in place that incentivises the key people from those contractors as opposed to the companies. So we're trying to push down the incentivisation to the actual superintendents or supervisors on site as opposed to just awarding company XYZ a whole bunch of money for hitting the schedule.
Okay, excellent. That seems very sensible. Thanks, Adam. And Tony, congratulations on the Offtake and the funding package with Floor. That was pretty special. I'll pass it on now.
Thanks, Rich.
Thank you. Your next question comes from Glenn Lawcock with Barrenjoey. Please go ahead.
Afternoon, Tony. I've got a couple of ones. Firstly, I think Adam touched on this, but I wonder if you could just clarify with the 545 million capex, how much actually is fixed versus variable, and then is there a large US dollar component involved in it as well? That's just the first question. Thanks.
Essentially, it's all fixed, and there's very little US dollars. It's all in dollars.
And sorry, I missed the start of that, Adam. I think you talked about a lot of only a certain part. You went with a strategy of fixing a certain part, and then if you went and won
In terms of that was with reference to the EPCM. So we're looking at fixing nominally in terms of the EPCM award. About 65% of that will be fixed, and the CM portion is reimbursable.
But on the construction side?
On the construction side, it's all reimbursable, yeah.
Yeah, so what would that represent then of the 545 if you had to split it fixed and variable?
Probably 200, 250 would be variable of that order.
Okay, thanks.
Financing PEI and civil and concrete works.
Yeah, and as you said, very little US. Okay.
Yeah.
Second one, Tony, is just interested around your thoughts on capital intensity. Yesterday, obviously, one of your peers, Pilbara, announced 300 million for an additional 100,000 tonnes. Now, there's some money being spent for the expansion to 1 million, but essentially they're going to spend something in the order of the same amount of money as you, but get 20% less spodumene out the back, so their capital intensity is 20% more, and theirs is a brownfield expansion, yours is greenfield. So, I'm just trying to understand how your capital intensity turns out to be 20% less than, say, someone else doing a similar project, but only an expansion of an existing business. Any thoughts you might have on that?
Clearly, given my apprenticeship at BHP, capital intensity is something that I've continued to track and monitor. Now, I can't speak for Pilbara as to why their capital intensity is what it is, and I've been very deep in our numbers, and I'm pretty comfortable that, as I said, I wasn't in a position to pad the 545 with this 30% inflation. We believe the escalation amount that we've put in is fit for purpose, and we're going to manage it. Right? And as to the construction, I think brownfields expansions are always, there's a little bit of interface issues that make them a little bit more expensive. So a clean canvas for us to build something fresh and efficiently gives us that scale efficiency that gives us the capital intensity.
No, that makes sense. I remember one of your previous projects, not yours, but your previous company, where Worsley expansion was a brownfield and it ended up double, was ridiculous. So I understand brownfield can be bad. Just the final question for you, Tony, if I could, just on the facility with Ford, just trying to understand it a little bit clearer. So do you start capitalising interest from day one or only when you draw it down? And then just that comment in the release about distribution. So can Liontown start making distributions while the facility's still on foot, or do you have to repay the facility in full if you want to start making distributions? Thanks.
Okay, I'll start with the second one. We can make distributions in the course of construction, right, and building, but those distributions are agreed as to there's a minimum requirement that we need other elements of our company expansion, Baldania, the refinery, PFS, etc., there's got to be a bit of flow up, and there's an agreed amount of distribution, and then after that agreed amount of distribution, whatever's left, then is a sharing. So if we've got surplus cash flow, that can go back and pay off the loan quicker, but also, we get to top up our requirements as well. So that's how the distribution works. On the capitalised interest, I don't want to give you a bump steer. I think it's the moment we draw it down, but I'll confirm that.
All right, that's great. Thanks, Tony.
Thank you. Your next question comes from Andrew Harrington with Petra Capital. Please go ahead.
Good day, Adam, Tony. Thank you for your time. My question's about Offtake. Is the material that you will be providing going to existing plants that are short material, or new plants that it's going to be the foundational material for new refineries? So what's the destination of your Offtake?
Yeah, so the destination of our offtake for each of the customers is different. There are some customers like LG that will look at initially tolling it through some Asian refiners, predominantly China, but they're looking at also doing arrangements in Korea. I'm not privy to those, but that's at a high level what I understand is the case. With Tesla, I think it's, what I can say there is, I think it's public knowledge they are building a refinery in Austin, Texas, and that refinery will have train 1 and train 2, and I can only assume that potentially some of our product will go there, as well as probably some arrangements they may have in Asia. And with Ford, I'm not sure what their plans are specifically.
All right, that's it from me. Thank you.
Thank you. Your next question comes from Hayden Barstow with Macquarie. Please go ahead.
Good morning, Tony. Just, I know you're sort of doing the work on the mining. Just sort of keen to understand sort of your thoughts around that underground. Sort of, is the biggest sort of room and pillar type stuff where you're likely to go first and push that more aggressively, and that's where we could see a bigger volume of tons or a faster ramp up in phase 2, or is it sort of going to be sort of a bit of both from the vertical ore body and then the bigger underground?
I think I can give you a response, but I think Adam has probably got across the specifics better than me.
Yeah, we're still working through that, Hayden, I think is the best way to put it. In the DFS, we had an approach where we targeted the northwest area and got down into some of that rim and pillar early. But the rim and pillar is actually a small fraction, as you're probably aware, of the overall. I think it's 3% from memory of the overall underground mining. I think current thinking is that we may go to that Mount Man area as a preference currently with the long hole open stoping, and we're looking at some longitudinal mining techniques now to reduce the development. I'm hearing numbers anywhere between 10 and 20 kilometre reduction in longitudinal in development in that area if we can longitudinally mine those upper Mount Man stopes. So we now have a 3-man team on board, and we're recruiting a couple more of our own underground mining professionals, and we've brought all that in-house. So we've done a third-party review, quite a few opportunities identified, and we're going after them now on the mining. So we see the DFS as a point in time, and we've actually transitioned now to, we're actually going to mine this. How's the best approach? And there's also some capital considerations there in terms of, obviously, the development is all capitalised.
And just to further add on that, when we were in discussions with commercial banks, we were well into due diligence, and we had the whole underground mining side of it independently reviewed for the banks as part of that requirement, and that actually surfaced some opportunities which Adam has spoken about, but also we've had some further work done in the last month that's identified other areas of opportunity. So I think there's a lot more work to be done
at this time. I'll now hand back to Mr. Reid for webcast questions.
Thanks, Melody. I see we did just have a question pop up from Peter O'Connor. Can we take him?
Sure, Peter O'Connor from Shaw and Partners. Please go ahead.
Thanks for squeezing in, Tony. Offtakes, take or pay, are they? Yes or no?
We need to supply and the customer needs to buy.
And when does that take or pay kick in?
From the moment we announce commercial production.
Options around the contracts, plus or minus, given market changes over time, what flex is there?
We have tolerance levels on the annual production at our discretion. So I can't divulge how much they are, but we have got tolerance that we can call. And also there are options where we can, if we have a surplus production year, that we can offer that surplus tonnage to the customers as well. So we've got optionality there. And finally, if we decide that we don't want to sell into the spot market, we can sell some of that spot tonnage back into the contracts.
Given your and our history in bulk commodity contracts, that's kind of the best thing we've got to go with, given this is a new market. Do we think about it that way? Like 10 or 15%, is that the type of flex you've got built in?
Yeah.
Okay. And the funding, when you looked at the commercial banks versus forward, the decision-making process was driven by coupon, duration, tenure, or was it driven by the funding on the other side of the offtake? And what was the spread between commercial banks and the forward debt?
Okay, there's a bit in that question. I think I can tell, we had the commercial banks, let me talk a little bit about that. We went worldwide in our sort of expression of interest. We had 11 banks participate. We shortlisted it down to 3, an international bank, a domestic bank, and a government policy bank. And we had very, very competitive commercial rates, equivalent to home loans. Right? 4 came along and gave us the terms and conditions that we've now announced, and which were fairly compelling. But I think when it comes to the overall package, it's not just around the commercial terms that the board looked at. It's around the whole, how can I put it, the governance and infrastructure that goes around the commercial bank loans, the covenants, the reporting requirements, the administration that goes with a commercial loan. So when we looked at what Ford was prepared to offer and what the commercial banks did, it became fairly obvious to us that the commercial rates plus the overall administration of the loan, it was a far better proposition. The last point I'll make on this is, I think I made this point in my presentation. Both the offtake and the commercial loan was negotiated at arm's length. One didn't subsidise the other. I think that's an important point.
Thank you. Just last one. Going back to the very first question, my second question about customer engagement. And you talked about the requirement to get feedback. During the process of building, you talked about there are certain checkpoints. Is that an audited checkpoint process, and who does that audit?
For the customers, there is
when you're building, you've got to give the feedback to how you're going and what. I guess the owner's going to take a call from you, Tony, and go, hey, we're fine, we're up to date. They want some independent verification. Who does that independent audit for the customers just to check that you're tracking fine?
The customers have the opportunity to send their own team to review and inspect the project as it's being built and as it's being operated actually as well, to satisfy that we A, meet their ESG requirements, and B, that we're going according to plan in terms of our construction. We do need to supply the customers with verifiable and reports, construction reports, right? But most of the work will be done by the customer's internal team.
Okay, just going one last one, the comment about labour rates. Did I hear you right? That labour rates post the DFS, did you say 30% higher? Or was that unit labour rates, or how do I think about that 30% number?
I think it's about salaries that are being requested. I think would be the best way to frame it.
That's the top end, of what we're seeing. It's not necessarily what we're bringing on.
I was going to say not what we're paying, but what we're being requested.
Yeah. So I think Adam answered that question where our DFS, we took a fairly pragmatic view and we based all our salary module on the P75, not the P50, the P75. So I think we've factored in a fair degree of inflation already in our labour module.
Just maybe a lazy question, but to make it easy, where have you shown for a split in the OPEX per unit, be it labour, consumables, energy, etc.? Is that available? And if so, which document do you know where that would be? Easy to locate.
Yeah, I don't think we've split it. In our DFS announcement, we have split it by activity, mining, process, but we haven't split it by cost element.
Thanks, Tony.
Thank you. There are no further phone questions at this time. I'll now hand back to Mr. Reid for webcast questions.
Thank you very much, Melanie, and thank you to everyone on the teleconference for your questions. We do have quite a number of webcast questions, so we'll dive into them and get through them as quickly as we can. The first question from David Day is, when can the market expect to hear some further results from drilling of the Baldania deposit? And while we're dealing with Baldania, a number of other shareholders have said what's likely to happen there in the next 3 to 6 months.
Yeah. We did that initial bit of exploration work around Baldania earlier this year, and we identified a couple of interesting targets that we're going to further explore, especially the Northwest Territories. The plan is to do some drilling there later in this year, because we've got some rigs drilling at Kathleen Valley at the moment, and then we're going to move them down. Now, I think it's safe to say that whilst we're very, very optimistic around Baldania, it's not going to be a Kathleen Valley, okay? But it'll be something that will be very strategic in our portfolio as it moves forward into refinery, our refinery aspirations. So there's a lot of work that we're doing, and if the Northwest Territories proves to be, or the Northwest area, I want to call it the Territories, proves to be as prospective as we think, then there may be a revision in our strategy.
Thanks, Tony. The next question is from Paul Henrahan. He says, given that Kathleen Valley is a low-cost, long-life, scalable operation, are there any limitations on utilities that Liontown is still working to resolve, such as tailing storage, water, power, etc.? And is there any limitation on final throughput related to those utilities?
Hi, Paul. Thanks for the question. I'll break it down. Let's look at the utilities. I think we're well covered for power. We've got expandability in our current renewable farm, and we are we're future-proofing it for the 4 million tonne expansion. So we think we're fine from that perspective. The second thing is, the ore body and the underground mining. We're expanding to 4 million tonnes. We think that's probably optimal. But if we find more resource, because we haven't closed out Kathleen Valley yet, then there is the opportunity to potentially expand beyond that. So at this stage, we think we've probably got the sort of optimal level for the mining side of things. Tailing storage, no question the area is tight, but we've designed the tailing storage facilities for life of mine, and we're comfortable within that.
Yeah, I think the only other thing is water. We've obviously defined sufficient water for startup, and we are exploring further. So we've been very, very active in the region, securing additional question here about when do we expect drilling results from Kathleen Valley. I think Tony did mention that, and we've had a few other shareholders ask about the drilling at Kathleen Valley, what the objective is, and will that lead to an updated resource estimate?
Yeah, so the objective of the drilling at Kathleen Valley is we basically stopped drilling at Kathleen Valley for two reasons. One, we wanted to preserve cash and move into the DFS. We had sufficient resource to well and truly cover off on the DFS requirements. But secondly, we didn't have native title clearance to drill in certain areas. And now that we've got the native title agreement and the Section 18, it enabled us to go into these areas and do further drilling. The ambition is to actually understand how big Kathleen Valley is. So we want to understand that so we can factor in that optionality now. And it goes to the question that Paul Henry asked for around ensuring that we're building in optionality, that if this thing is double the size, that we're not sterilising that optionality. All right, now when do we anticipate to conclude that? There's still a few months worth of work there. And what is a problem here in Perth is assaying and getting results back. It is taking a long time. So I can't give you a date on to when we get the assaying back.
Thanks very much, Tony. The next question here comes from Navin Jasani. He's got a two-part question. Do we see any kind of, or do you see any kind of future upstream investor coming on board, such as we've seen recently with Vulcan? And secondly, is the company, do you see any strategic acquisitions in the pipeline?
Maybe I'll answer the second one first. I'm going to focus on building Kathleen Valley. We've just spent an hour talking about the challenging environment. I want my management team and the board wants me, and rightly so, to be focusing on building Kathleen Valley. So that's where our focus is. Should an opportunistic M&A opportunity come across my table? Yeah, by all means I will look at it. But I'm not going to actively go out there looking for M&A. I've got a world-class asset that I want to develop. Sorry, the second question was future upstream. Yeah, future upstream. Look, there's two ways I look at it. We want to keep Kathleen Valley, the asset, 100% owned by Liontown and its shareholders. So we're not looking at any sort of equity position at the Liontown level, similar to what Vulcan did, or Pilbara for that matter. But on the refinery and the refinery asset, we acknowledge that we don't have the expertise in this area, and to bring on refineries, the Australian producers are finding it's a lot harder than people anticipated. So we want to bring in a partner that is well credentialed in this area, and we'll allow the passage of time so that we can select the right partner.
Thanks, Tony. A question here from an unnamed shareholder. He says, does current financing account for mine staff operating wages, and what about mine heavy equipment lease and purchase maintenance?
Yeah, so the second piece, our capital and operating costs are factored in as part of the funding mix. So the mining services contractor and the maintenance costs that go into that will be part of the mining services contract. The operating personnel, so the way we operate will be contract mining, but we'll have our own people operating the process plant. And as Adam pointed out, we've got that labour cost factored in as part of our operating cost, and it's factored in at the P75 level.
And we've factored in within the CapEx too in terms of ramp-up.
Yeah, ramp-up as well.
So there's sort of a mobilisation allowance, if you like, over the course of next year to build all of those operational teams up within the CapEx.
Yeah. And we've got provision for certain amounts of yellow gear in our own capital estimate, but the mining services contractor will be responsible for bringing on the mining equipment in order to undertake their job. And that capital charge will be part of their maintenance or their charge back to us.
Yeah, and I think we've already purchased the longer lead time, so we've already bought the cranes for the project. We've already ordered the first block of cars. demos, so a lot of that stuff's already happening. Thank you very much. Next one is from Mitchell Green. He says, with regard to your confidence levels in contractors for construction of the village and the plant, can you talk a bit to your level of confidence in the viability of their timeframes, given that we've seen a lot of large construction companies defaulting in the last 12 months?
Yeah, so before I sort of hand over to Adam, part of our adjudication process on every tender is to do both a financial and a sort of a operational audit and verification. Right? So as best we can, we are digging in deep because of that very risk as to the financial strength and wherefore of the companies that we want to interact with. Okay? So that's the first thing. The second thing is, I think it's safe to say that the reason we've adopted this divide and conquer, as Adam calls it, is to get smaller contractors that were not reliant on one big contractor doing one big scope piece. Should a smaller contractor fall away through some adversity, given their size and their contribution, we feel that we can adequately replace them should that event occur. But again, I'll go back to my first point is we do a fair bit of screening before we engage them.
Yeah, and I think Tony touched on it as well earlier. We've engaged, for the camp alone, we have 4 dedicated people from our side managing that contract. One very experienced guy that's worked for me in the past on 4 or 5 separate camp builds. Another very experienced guy and a dedicated engineer plus a junior engineer, and this is just for a camp build. On top of that, we've got a third party engaged from a financial point of view, doing a fairly regular health check on that company, so we ensure they have enough money, and the contract's structured in a way that we manage the money that goes to them as well. So a lot of oversight to give you an idea on that, say that one contract, and that same sort of rigour I think will apply across all of the contracts.
Excellent, thank you.
In that vein, Dr. Torfik asks, do you think we will be able to shorten the duration to production?
That is a great question. That's another. And the reason we're laughing is because Adam knows my, let's call it energy. And look, we'll do everything we can to meet our commitment to the market. And I've made that point clear. Is there opportunity for acceleration? I don't want to call it now. The market's too tough, way too tough. So, but I won't stop asking the question, but I think we've got to be realistic.
Yeah, I think success for the project is meeting the schedule in the current market, given what everyone else is experiencing. Yeah, that's our aim. Thanks very much. Alan Hazelwood asks, what was the reason, this is Offtake strategy, what was the reason for changing from targeting 5 customers all over the world to 3 of which 2 are American?
Look, we've made it clear that there were many aspects to the Offtake strategy that we would consider when selecting customers. Their geographic diversity, their position on the value chain, their ability to have more than just one aspect to their business. For example, in a converter who's converting our spodumene to hydroxide, they're heavily dependent on the EV market, right? And sales within the EV market. If we have a company that's big enough to be able to support a downturn, its financial strength through that downturn was also very critical to us. And it just by happenstance that 2 of our 3 customers were US based, right? They satisfied those other requirements, and that was good enough for us. The reason we went down from 5 to 3, we put it on for smaller increments of Offtake, but one of the attractions of our proposition to the customer is this. by offering a customer 150,000 tonnes of spodumene a year, it allowed the customers to line up a converter, and that converter can dedicate a whole train in their refinery to our product, and therefore tune and optimise the product delivery. If we offered smaller parcels of offtake, then they have to blend. That increases the complexity and also the operating cost to that converter. So it was very appealing that we offer those 150,000 tonne allocation slots.
Thanks, Tony. One final one on offtake. An unnamed shareholder says did Ford offer the 300 million just to get the deal over the line because they were competing with other potential partners? Did you have many other potential suitors? And he says, by the way, you're a legend. Thanks for your
Okay, I'll answer the second one that I'm a legend first. All I'll say on that one is we asked Ford to give us your best shot, given how competitive the last offtake was, and they did. Thank you. Just to go back to Glenn's question, Glenn, I was right. Interest starts accruing the moment we draw down the various sums.
Great, thanks very much. I think Tony does have another commitment coming up, so we might wrap it up. If we haven't covered your questions, apologies for that. I think we've covered the bulk of them there. So I'll just hand back to Tony for a couple of closing remarks.
Thanks, Nicholas. Once again, I thank the existing shareholders for their support. If there are future investors here, then I hope today's discussion with myself and my Chief Operating Officer, Adam Smith, gives you sufficient confidence that you will become an investor, and I hope you do soon. And finally, for the people that cover our stock, I hope we've provided sufficient context behind some of our decision making. Thank you.
Thanks very much. That concludes today's webcast. Just a reminder that